Coming up today, is the stock market dip over? A look at historical data, where Goldman Sachs says we're in the AI boom. A look at Tesla going into earnings tomorrow. Gold and oil pullback. Is that the end of geopolitical tensions? And a look at Bitcoin after the halving and all the other most important charts out there. Let's go, guys. And a warm welcome back to the Click Capital channel, everybody. I hope you had a great weekend. We're off to a positive start here. For this new trading week, got the S&P500 reclaiming ground above 5,000 today on a bit of a bullish bounce across the board. We can see the market picture changing up the front here with volatility, yields, oil and gold coming off and a bit of bounce up in a few stock sectors as well. However, we've still got a little bit of a defensive rotation. I can see that today with consumer staples, the second best performing sector, followed by utilities. And I've just updated my main technical chart at the moment, currently testing out the new volume candles feature that's currently in beta and only available to TradingView premium accounts. That's the top tier pricing level account for which I have. And basically volume candles is as it sounds. The more volume on a certain day, the bigger the width of the candle, and then on low volume days, produce really narrow width candles, which kind of makes it easier to visualize big volume moves and then low volume consolidations and pullbacks. So we're green across the board in all indices today. Market had been pricing in a lot of geopolitics the last couple of weeks. However, like I said on Friday, that looks to have resolved itself with a really calculated response from Israel towards Iran, for which they've taken the cue and appear to have dialed things down for now. And there's a look at the swing trade I gave you guys on Thursday afternoon in JP Morgan, just a few ticks away from hitting the 50-day VWAP here, as financials continue to lead again today with another breakout for Wells Fargo. Looking pretty good here on the chart. And stick with me because I'll come back to the charts and I'll show you some other interesting ones out there, including Tesla, which is continuing to slide going into earnings tomorrow afternoon. So the question is now, the S&P 500 has done a 5% pullback from highs. Is that the end of it? Is this dip over? And just like I showed you on Friday afternoon, typically dips based on geopolitics should be bought looking back in history as the market gets worried going into some event. And once that event happens, like we saw with Israel and Iran last week, typically things cool down and the market can have a little bounce. And just looking back in history, for the maximum drawdown each year, the S&P 500, on average, the intra-year drawdown is about 13-14%. So here we are now at 5%. You could pretty much just consider noise. There's only 2 other years in the S&P 500 history where the maximum drawdown was less than 5%. So the odds are we could still see a bigger dip, even if it doesn't occur during this current dip, may occur later on in the year. And we have had a bit of deteriorating breadth of late, just looking at this chart of the net new highs, stocks making new highs versus new lows. Both the NYSE and NASDAQ actually gone into negative territory. And typically when that happens, makes the market at least a little bit heavy, consolidate, if not fall a bit. Another not so good sign for the stock market is the real lack of buying from corporate insiders. It's actually the lowest it's been in over a decade. And something that's likely to keep pressure on stocks for a little bit is the higher for longer interest rate environment that we're now in. Looking back in history, the average length of time from the Fed's last rate hike to their first rate cut is on average 8 months. Here we are now, already at 10 months, and the Fed's indicating that they're not likely to cut anytime soon. Looking back in history, that's not normally a good thing for the stock market. They're on hold for 18 months back in the late 60s. Stock market pretty much went sideways before it dived into 73, 74. Same again in 97, 98. The Fed was on hold for 18 months. The stock market still went up for about another 2 years into its blow-off peak. And most recently, 2006 and 7, as the stock market was nearing the end of that current bull market back then as well. And so last week I presented a chart showing a near record discrepancy between what you can earn in cash and the S&P 500 dividend yield. And one of my YouTube subscribers correctly pointed out to me that doesn't take into account buybacks, which have really become a big thing in modern day markets this last decade or so. And so I found some data that looks at the buyback yield plus dividend yield on the S&P versus just the dividend yield, which currently at 1.38% is near record lows from 2000 and well below the long-term average of about 3.5%. However, looking at the buyback yield plus dividend yield, last print is 3.13%, which does make it a bit better. However, looking at the past 15 years, ever since the Fed has done a lot of quantitative easing, it's near the lows when looking at that valuation measure, but nowhere near as bad as 2000 when it was around 2%. And according to Goldman Sachs, we're still only in phase 1 of AI's stock market takeover. They characterized the first phase being kicked off with the launch of ChatGPT early last year that catapulted semiconductors like NVDA, who you could think of kind of as the picks and shovels. Companies of the AI boom, making all the semiconductor chips that these AI models run on top. They think the second phase will be other firms to benefit from the AI build-out, not just limited to semiconductors, but instead cloud providers, computer equipment makers, and security software developers. Also extending to real-world infrastructure, as AI will need expansive data centers to run it, something I've covered on this show as well, and how that ties into nuclear energy. They think the third phase, as generative AI advances, will be firms that can integrate the technology into their offerings that will win out. For example, like Microsoft with their Copilot tool, who some like Wedbush Securities' Dan Ives calls it an iPhone moment for the company. Then finally, Goldman thinks the fourth phase, with infrastructure and services established to support AI, will win out in the long run, like software and services companies, and companies that currently have relatively high labor costs will be able to increase their margins as AI will replace a lot of human-based roles. And so what's going to have a big effect on the stock market this week and next is getting into the thick of Q1 earnings. About to hear a lot from mega cap tech, and they should come in with good numbers on the back of the AI boom. Market will be very upset if they don't, because we've already got some high rates to deal with, plus a higher VIX. So the bar is set high for these reporting companies to come out and impress on numbers and outlooks. Bank of America thinks Apple will be able to soar 36% as it gears up to launch an AI-enabled iPhone. It's actually one of their top picks for this year, and they think the AI-enabled iPhone 16 is going to get them back to the good times after the stock price has been weak for quite some time, and especially this year as well. Already down 14% year to date. And Apple's earnings, about a week and a half away, and it was just on Friday they lost key support below 165. The real big one this week is coming tomorrow afternoon, Tesla, and they have quite a lot to prove to this market at the moment. They've been getting hit left, right, center on a number of issues, and they slid lower again today on the back of more price cuts for their vehicles across the board in the US, China, and Germany, along with reducing the price of its self-driving software. And this is in response to a flood of cheap EVs coming out of China, as Beijing has strongly stimulated their EV industry as they seek global dominance. And not only electric vehicles, but all types of clean energy technology. And Tesla still has a lot to prove with their latest products, the Cybertruck and the upcoming Robo-Taxi, which they're set to unveil on the 8th of August this year. Earnings per share are expected to come in at 49 cents tomorrow. And looking at their last quarterly earnings back in January, they missed by a little bit. They missed by even more in their earnings prior to that in September. And it wasn't since July last year from when they last beat, but the market ran up into that and saw it coming. So they may come in a little softer or as expected. However, as always, the market's reaction is what's most important, because it looks like the market's expecting a soft result, may have already priced it in. So we may get a dip and then it may hold. It all depends how bad the numbers are, and also importantly what the outlook is, and it could be a soft one given what's happening in China, and with the price of used Teslas continuing to fall. However, Tesla, a bit more of an isolated story. Looking across other mega cap tech, got a bounce today in NVDA, up 4.3% after we came off hard on Friday, down 10%. A little bit of a bounce in Amazon. Meta pretty much finished flat, and Alphabet Google, still the best performing large tech company, just a few points off all-time highs. And just staying on the charts for another swing trade idea, I'm currently looking at the Consumer Discretionary Fund. If we are going to get a bounce, this should be a good play back to the 50-day VWAP here. I can see we've got 3 consecutive reversal signals. We're oversold on the DSI. The trend strength is negative, which means the market's ranging. Institutional buying is almost back to bullish territory. It could be stalling out where the market last stalled out in early February. Got a bit of a spinning doji here below the buy-sell band, and currently 5.5% below the 50-day VWAP. And just looking at a potential long trade setup, if we gave it a bit over 2% wiggle room, by the time we got to the 50-day VWAP, maybe around 175, 176, still a pretty good risk to reward ratio there of 1.5, and being a very liquid sector fund, very little tail risk in it too, unlike small stocks that can have big gap downs overnight, and we don't have to worry about earnings too much. So we'll keep an eye on this on a bit of a swing trade reversion to the mean, back to the 50-day VWAP. And so it looks like based on last week's events with Israel, Iran, things cooling down there. Like I said, with Israel's really strategic and calculated response appears to have achieved its objective. And so for now, we've got geopolitical tensions cooling down. Bond yields holding steady today. However, the big move was out of the recently hot gold trade, posting its biggest one-day drop in over a year. What's clearly a response to things cooling down in the Middle East. So that's obviously what the market's been trading on and will continue to trade on. And we do have some firm bond yields, along with the US dollar, which is a little bit of a headwind to hard assets like gold. Same with oil, getting back down there as tensions cool down. Supplies in the States are flush, and the Biden administration hinting at potentially releasing oil from the Strategic Petroleum Reserve. It's all helping to keep a lid on the black stuff here. However, we're not completely out of the woods yet. We just had Russia today warning that the risk of a direct military clash between Russia and nuclear powers in the West is rising and that the world is on the brink. And this is in response to the US House of Representatives passing a $61 billion foreign aid package for Ukraine over the weekend, in which is very controversial to say the least. And so the West and Russia are already at war. It's just been fought via the proxy of Ukraine. Just like the West is already at war with Iran via the proxy of Israel, and very well in the near future could be at war with China via the proxy of Taiwan. That's why we've got global military spending hitting all-time highs last year after a 7% jump. And that's the only area of US government spending they're really allowing to increase and stay steady compared to other categories of government spending. And this is unlikely to change anytime soon, even though for now we appear to have avoided a potentially much worse situation. However, that could easily change at any moment's notice if Iran want to surprise back and attack Israel. However, that looks unlikely at the moment, with Israel successfully striking right next to their nuclear site in Isfahan. Moving on to Bitcoin, we got a little bounce after the halving took place on Friday afternoon, with some like Standard Chartered still calling for the digital token to head to $150,000 by year end, despite this recent pullback and consolidation we've been happening over the last couple of months. And I think that's going to come on the back of huge wave of investor inflows into the spot Bitcoin ETFs, with them predicting between 50 to 100 billion flow in over the next 2 years. And there's a look at Bitcoin today, quickly approaching back to its 50-day, currently at 66,500. A little bit softer for Ethereum, and we're still waiting to hear from the SEC whether they're going to approve ETFs for this one as well. And there's a look at the largest Bitcoin ETF on the market from BlackRock, their iShares Bitcoin Trust, IBIT, which we've been consolidating for about 6 weeks here. Pretty slow day on the economic data front. Going into tomorrow, we'll get some manufacturing PMIs. Wednesday, durable goods. Thursday, GDP growth data. And finally, Friday, the big one, PCE price index inflation data. Market may coil up going into that, and we could get a move off of that data. Not much change in Fed fund futures. Still only pricing in one rate cut this year. And fear and greed index still sitting in the middle of the fear zone, and we still don't have much corporate insider activity. Getting a bit of a bounce in short-term breadth here, 28% of stocks above the 20-day average. However, we still have negative breadth when looking at new lows versus new highs. Again today on the Nasdaq, 80 new lows versus 25 new highs. There's a look at 2-year government bond yields, just sitting below 5%. Nice recovery for high yield bonds bouncing up off their lows from Thursday. The dollar index just consolidating, and there's a look at that move lower in gold. Still too early to tell whether it's lost this uptrend. We'd have to see a close below the 50-day for that. However, crude oil, a bit weaker, actually consolidating just below its 50-day. And look what we have here, a bit of a fat green candle in wheat futures. Something we've been looking for lately as potentially an upcoming sign of more food inflation. Same deal with corn as well. Still consolidating here, but could be setting up a base for a breakout. And there's a look at the hot cocoa trade. Coming off a bit today, but not too much volume. China trying to defend its 50-day VWAP here, and I think clean energy is pretty technically oversold here. Not a bad price for long-term investors like me, and we've still got a bit of a breakdown in the consumer discretionary versus staple spread. Market's still in a little bit of a risk-off mode. However, looking at credit spreads, they're still holding up really well, so the market's not really worried about any big economic problems right now. And every stock sector finished in the green except the gold miners. Coming off pretty hard there today. And another good move up for utilities, almost breaking out to multi-month highs, which is pretty good considering the move in bond yields. And that's why REITs are still a little soft here. There's a look at the hotly traded Trump media, just pulling back, calling up on low volume, and a bit of a bounce in some of these other semis like ARM, AMD getting a first reversal signal, and Supermicro Computer putting in a little hammer formation, and a bit of a bounce in MicroStrategy. However, considering Bitcoin only came off 19% in its pullback from peak to the lows last week. It doesn't look like it, but MicroStrategy actually came off 43%, and that's what I'd been talking about. You could think of MicroStrategy as like a highly leveraged play on Bitcoin. Bitcoin came off 19%, it came off 43%, and I think that would be exponential as well. So you can imagine if Bitcoin ever came off by 30, 40, 50%, this stock could crash 70, 80% or more like it has done in its history before. There's a look at Netflix after it got slammed on Friday after its earnings. Did find lower highs, lower lows today. And even though crude's pulling back, we've still got ExxonMobil and Chevron trading reasonably firm given the pullback in crude. There's a look at A-Mark Precious Metals calling up, starting to converge with the 50-day, and a strong move up there. The price of Ford as we go into earnings on Wednesday. Had earnings out from Verizon today. Huge bearish engulfing candle after we gapped up, even though they came in with a little beat. Market didn't like the outlook. And like I said, looking at financials, they appear to be one of the leading sectors here. Actually still breaking out to highs with a bit of catching up to do for Citigroup and JP Morgan, which had been lagging the most. However, it appears to be catching up here as well. All right, guys, there we are. To start off this week, big events. Tesla tomorrow. Make sure you come back for that one. PCE inflation data Friday. Looks like things in the Middle East have cooled down. Along with it, gold and crude, which should help continue bringing the fear index VIX down lower, which then is positive for stocks. However, on the other hand, we've still got some pretty elevated short-term bond yields here, so that's a headwind for stocks, and we'll see what other big company earnings bring us. However, I'd say if we do get a little bounce here, it could be set for a period of consolidation for a little while, like we can often get seasonally at this time of year in an election year, so the market could be a little soft for a month or two. Other than that, we'll keep following the price action day to day, and I'll do my best to keep you informed on everything that's going on out there. Thanks very much for tuning in to my daily market review and hitting that like button, and I'll see you all again tomorrow night. Cheers.